Good morning, ladies and gents. Simon Brown here. Today, looking at saving versus investing and understanding what the difference between those two are. On the surface, same thing, and certainly two words that I think are used interchangeably, but truthfully have very marked differences as to what they actually mean and how we should view them in our broader financial aims. Both important. It's not a case of either or, it's a case of both. They have their right place, and part of that right place very much is understanding what they do and how they work. Short answer, savings protects your money while investing grows your money. And you can see from that the words left out. Saving protects your money, but are we getting much growth from it? And that really is a factor of inflation. If you're saving, you're earning interest, you're probably getting interest at or around inflation. At the moment, we've got a fairly low inflation rate, sub 3% in South Africa. We can get saving rates in the banks of around 4, 5, 5.5%, some fixed deposits and long term at a longer rate, but we're only just ahead of inflation. Investing grows your money. You notice the lack of protect, and that's because investments into the stock market are volatile. They can be more volatile. Frames, they have different risk levels, and therefore they're going to have different products that we would look to use for either the saving or investing, depending what we're looking for. And as actually, savings can be very short term, as in, maybe it's for days, weeks, months, maybe some years, but it's typically going to be that shorter term money, and it's oftentimes for specific goal. For example, you're saving for a deposit on a house or perhaps a new car. Maybe it's education for your kids, or maybe it could be a wedding or a holiday, a large expense in that sense. And those are all going to be specific goals. You've got a date in mind, you've got an amount in mind, and you're working towards that. An emergency fund, that's very short term, in the sense that you need an emergency fund for in case something happens. You lose a job, the geyser bursts, some unexpected pain on your income, or perhaps an increase in expenses due to something unexpected happening. And that really is your very, very short term. Now, an emergency fund in an ideal world, you never tap into it. It just sits there, muddles along, earns a modest amount of interest, but serves its purpose when something happens, such as a pandemic we're seeing right now, and suddenly you need the cash. The others are very much more date and time, and you can roll it back. You can say, well, I want to save so much money within the next 3 years for a deposit on a house. Let's say it's 50,000 I want to save, and you can break that down. So 50,000, you've got, say, it's 3 years. So if you save about 1,300, 400 a month, you will get to that target, including the interest that you earn at the same time. What the interest-bearing products do is they create certainty. Your capital is safe, and they then earn that interest on top. And that interest could be fixed or floating. It could be just money sitting in a savings account. It could be a fixed deposit, a term notice, a 32-day call. It could even be one of those lock-ins, a 3-year, 4-year, maybe even a 5-year. The retail government bonds offer 2, 3, and 5-year lock-in period. You'll get your money back. You'll get the interest that you accrue. Either you reinvest it or you take it out for spending, depending on your requirement. But it is very much a case of this is an interest-bearing product. It is the sense of the money is safe and your return, therefore, is more modest. So it is for those shorter term specific goals that are important. And a question coming, it could be almost anything that you're looking for in the short term. It absolutely could be. Anything that you're saying, I want to put some money aside, or maybe you have some money for something that's happening in a little while. And the point being is that, let's say you want to do something at the end of the year and you already have that money. I don't know, you're taking a holiday and you've got the money for the holiday. What do you do with it? Well, you put it into a savings product, and you put it into a savings product that will run for that period. So we're sitting towards the tail end or the middle of August. You want it for December, so you could put it into a 90-day call account that would then expire in November, late November, and would then pay out both the capital and the interest that you've earned over that period. The risk that if you put it into the stock market is it could end up by December being a whole bunch more, but it could also be a whole bunch less if markets have a tough couple of months between now and the end of the year. So it's really that saving product is about the certainty. It's about the short term. It's about very specific goals that you have in mind for the cash. Your capital is safe, and you're going to earn interest over that time frame. An investing product is different. It's a long term, so typically more than 5 years. It does have a specific goal, and that specific goal, typically, we're saving for retirement. Now, you might be part of the FIRE initiative, which is financial independence, retire early, and that's your retirement would then be perhaps an earlier date. But typically, our investing is for retirement. But it can be more than just that. You could be having a long term. It's maybe you want to buy a house in 5 years, and you're like, well, I know what I'll do. 5 years, I've got time on my side. Let me put some money into the market every month, into an ETF or whatever the case would be. So again, specific goal. Typically, it's going to be retirement, and that money then goes into the stock market. So in the stock market, you're taking short-term risk, but you're taking long-term growth. Stock market would be a pension, a provident, a retirement annuity as the first vehicle. A tax-free. We talked about those in the webcast of last week. It could be discretionary. In other words, discretionary. You don't get the tax benefits that are inherent within the pension, provident, retirement annuity, or within the tax-free. It could be individual equities. It could be individual equities or shares. It could be exchange-traded funds. It could be unit trusts. Any one of those sort of collective investment schemes that are available as an investor. So it really comes back to savings protects your money. It grows, but because of that protection, it grows perhaps slower. But you've got that certainty that when you need it to get married, make a deposit, go on holiday, pay for education, it'll be there. Investing grows your money, comes with short-term risk, but over the long term will do better. See a question coming, what if the education is sort of a child's university and it's a decade away? That's a great question. In which case, and again, it comes back to that time horizon, different time frames. If you've got a decade plus, well, then it can be into an investment a product. If your child is born today and you're thinking your child is at university, so that would be an investment product. There's a specific goal, and that is child's tertiary education. It could be done in a tax-free account. It could be done if you as time thing. Got $100 to of nines. Typically now an inflation. So your most months maybe predicting where inflation and interest rates will be over the next 6, 12 months, 3, 5, 10 years is immensely different. If you don't need the money, if you are working for a corporate, you probably have a pension of some sort, a pension, a provident, a retirement annuity. Of course, there are tax benefits. Your first 27.5% or 350,000, whichever is smaller per year, can be deducted from your income, so reduce your tax liability in the year. There's your tax-free investing, whereby any profits that you make and dividends that you receive are exempt from taxation. And then the third is discretionary, which is money that you invest after you've paid tax on it, and any profits that you make need the money soon, emergency fund, bank account, or maybe a holiday. And not for a long time, then you really can look at investments. And it is a case of, I have all of them. I have short-term money for an emergency fund. I have some money for the next 3 to 5 years. The current rand a year interest, or even 20,000 rand a year interest, you're not paying tax on that interest. So there's no need to put it into a tax-free account. You won't see any benefit because you're already not paying interest on that income. Ladies and gents, we will leave that there. We try and bring these in at 15 minutes, and that's spot on in time. Thanks for your time today. We'll chat again next week when we're back with our topic on exchange-traded funds. Cheers all.